I found my way into the business right out of school, kind of doing regular type Wall Street type interviews. And then alongside of it, I was a Yale undergrad and I interviewed at the Yale Investments Office. And I was fortunate that my first job was working for David Swensen.
Wow. What was that like?
That was amazing. It was an interesting time. So I joined in 92 and he had become the CIO in 1985. So he had been there for 7 years and he had very, I would say, novel at the time ideas based on first principles. He was a PhD in economics. He was a thinker based on fact-based knowledge, or people call it evidence-based investing. And people weren't doing that. And he had some innovative ideas, but nobody really knew what was, unless you were in the industry and you were, say, a money manager that Yale gave money with, nobody else knew what was going on until he wrote his book, which was a couple of years after I left. Maybe actually just a year after I left. So it was great because I was able to learn really great investment lessons grounded in first principles and then practice them. So it's not just reading the book, you're living it every day from someone who later became world renowned for being the very best in the business.
Was this the time that you discovered the other asset classes and then private equity? Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest topic of all, money. How to make it, save it, keep it. But our conversations lead us to an even bigger question, what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil Baranowski, author, TEDx speaker, and investment advisor to wealth creators with patient capital and an infinite investment horizon. I work with families and individuals who aspire to grow wealth over a lifetime and generations through disciplined, thoughtful investments in durable quality businesses while giving money meaning. Join me on this quest to unearth and share the wisdom of the ages. Let me share with you the podcast program disclosure statement. Blue Infinitas Capital LLC is a registered investment advisor, and the opinions expressed by the firm's employees and podcast guests on this show are their own and do not reflect the opinions of Blue Infinitas Capital. All the statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. The information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. None of what you're about to hear is investment advice. My guest today is Ted Seides. He's a famous podcaster, renowned industry expert, and a best-selling author who is all about compounding knowledge and relationships. We're talking about his new book, Private Equity Deals, Lessons in Investing, Deal-Making, and Operations from Private Equity Professionals. How are you, Ted?
I'm great. Thanks, Bogumil. Thanks for having me.
I told you that I've been reading your books for many years and listening to your podcast, so I have your voice in my head. So it's nice to have you.
You could just close your eyes while we do the interview then.
Almost. But it's nice to have you here. I want to jump right in. And you might know that I like to start these conversations with a more personal question. And I ask my guests about the early days, about childhood upbringing. And how do you think that time shaped you, your relationship with money, and the career path or paths that you chose?
Just a very simple question to start. I love it. So a lot of ways to answer it. I'll try to be, I'll just pull one thread, which is my father is, I guess, a psychiatrist. Mm-hmm. And I think I grew up with a fascination for how people tick, genetically, not because he psychoanalyzed us. And then I was also, I would say we were kind of upper middle class, and money was something my parents talked about in a lens of scarcity. So I always grew up thinking we were really upper class, but we just didn't tell people we were. But I had no idea what like having a lot of money was. But I had this desire. I had this desire, and I thought it was an obligation too. So I studied economics in college, and I think a lot of it was because I thought that was how you get money. Like, I was a math guy, and so it was a little bit natural. And then I found my way into the business right out of school, kind of doing regular type Wall Street type interviews. And then alongside of it, I was a Yale undergrad, and I interviewed at the Yale Investments Office. And I was fortunate that my first job was working for David Swensen.
Wow. What was that like?
That was amazing. It was an interesting time. So I joined in 92, and he had become the CIO in 1985. So he had been there for 7 years, and he had very, I would say, novel at the time ideas based on first principles. He was a PhD in economics. He was a thinker based on fact-based knowledge, or people call it evidence-based investing. And people weren't doing that. And he had some innovative ideas, but nobody really knew what was, unless you were in the industry and you were, say, a money manager that Yale gave money with, nobody else knew what was going on until he wrote his book, which was a couple of years after I left. Maybe actually just a year after I left. So it was great because I was able to learn really great investment lessons grounded in first principles and then practice them. So it's not just reading the book, you're living it every day from someone who later became world renowned for being the very best in the business.
Was this the time that you discovered the other asset classes and in private equity?
I used to joke, because I spent 14 years in hedge funds, that I learned what a hedge fund was the same day I learned what a stock was. But I also learned what private equity was and venture capital the same day. Like you, I spent most of my time at Yale in the public markets and most of my career in the public markets as an allocator. But I was around the private, it was a very small team. So I was around private equity. I was around venture capital. I knew the names of all the managers, though I didn't have close relationships with them. So yeah, I learned all about it at all the same time.
I think the two worlds can learn from each other. At the end of the day, it's all about ownership of businesses, and we'll talk more about it. But before we dive into the book, I'd love us to do a quick overview of the vocabulary, kind of the map of private equity landscape for the audience that's less familiar with it. So private equity, GPs, LPs, funds, deals, leverage, the size and the structure of the industry. What do we have to know to even take a bite?
I love it. Well, let's start where you did with ownership of a business. So in the stock market, you own shares of a company, and there's a price dynamic. Buffett talks about Mr. Market that bounces around every day. But ultimately, if you're valuing a business, you're valuing the cash flows of the business. Private equity doesn't have that psychology price dynamic very much. So you're really owning the whole business. And the activity really started and first got popularized in the 80s. And back then, it was called leveraged buyouts. And it was all the activity at that point in time was a GP, general partner, because you create a partnership. And the money comes in from a limited partner. The general partner is the private equity manager, the person who's going to go out and take that capital and buy a business. And they would buy a business borrowing a lot of money. And when I say a lot, they might put 1 or 2% of equity in. This is back in the 80s. And they could do that because the prices were pretty cheap, right? If you're buying it 3 or 4 times and a bank might be willing to lend based on the cash flows, you can actually borrow that much. And back then, all the private equity firms are then called leveraged buyout firms, some called corporate raiders. They only really bought other private companies. And that changed really most popularly when KKR went to buy RJR Nabisco in, I don't remember exactly the year, 88 or 89. And just to put perspective on that, the whole private equity industry raised about $24 billion that year. And this deal was a $12 billion deal. So the comparable today, the industry raises, call it $250 billion a year, that would be like someone doing a $125 billion transaction, borrowing $124 billion of it, or something to that effect. So it was very, very different. Right. And it got popularized really after the global financial crisis. It was always an activity that people like Yale and some select university endowments and foundations and a few pension funds and families had invested in as part of their portfolio, but it wasn't really adopted in the institutional world until you went through the financial crisis. And then the last 15 years, there's been an explosion of interest and more capital flowing to the private equity managers. So leveraged buyout sounds a little bit risky. So now they just call it private equity. So you could think of public companies as public equity, public shareholders, and private as private equity. The activity itself, the biggest difference is control ownership. So the GP or the private equity manager buys the whole company, and then they can determine, with the management, they can determine who's running the company. Is it the existing management team? Is it a new management team? How are they financing the business? Are they putting on a lot of leverage or a little bit of leverage? Do they want to make changes in sales and marketing or operational efficiency? So they actually own the business, as opposed to Buffett will say, buying shares of a company like you own the business or you're valuing the whole business. They actually own the whole business. And they're very influential in how the businesses get operated. They generally hold them for a couple of years, 3, 4, 5 years, and then they'll sell them on to either maybe back to the public market or another private equity manager or a strategic buyer.
I love this. I mean, that's a great way to start. There's a quote in your book from one of your podcast guests that I really liked. The quote is, "Private equity is all about aligning incentives and driving change." That's from Pete Stavros, who is an industry veteran and an author. Can you talk about that role that private equity has in the economy and business, and why do we need it?
Yeah. All different questions. So just to give a sense of scale right now, private equity managers own about 10,000 businesses, and it's a few $1 trillion of value. So it's not, half of the global economy, but it canvases everything. So private equity managers own everything from, sports teams to nappies and everything, or diapers, everything in the middle. So it's kind of everywhere, and it's in growing importance because the activity itself has been a really effective way to compound capital for institutions. And so there's significant demand for the activity that continues. So it's important to understand because they are owners of a substantial part of the economy. And yet it's pretty opaque to the public. In the institutional investing world, people understand it very clearly and deeply. For many years, much like hedge funds for many years, private partnerships were not allowed to publicize or market in public. There are SEC regulations. And so if you can't tell your own story, somebody else tells it for you. And most of that has been very negative. So you've had sensationalized problems and that will always happen, right? You own 10,000 businesses, they're not all going to work. And when you have leverage and you have cyclical downturns, businesses can fail. And so there are plenty of small stories that you read about real significant failures, but it's not like venture capital where, 8 out of 10 go to zero. For the most part, private equity firms make money, and it's just a question of how much they make. So it's important to understand because as a group, there's such an influential and important owner of businesses throughout the economy.
Well, you talked about being little understood and misunderstood, and you bring it up in your book, and I really want to explore that topic because I'm curious, what are the reasons and how do we misunderstand that whole industry from looking in from the outside?
Well, the biggest aspect of that is that sort of negative tilt that you see in the media. And it comes from, I think, the sensationalized failures, because you don't have that many sensationalized successes. It's not like you're backing Uber in the early stage and it becomes this massive public company and you make thousands of percents. It doesn't really work like that. But what you've had over the years, and then even last year, journalists wrote 2 different books that had the word plunder in the title. referring to the private equity industry as a whole.
Mm-hmm.
And they picked out anecdotes of subsectors that were problemed or businesses where the private equity manager went in, things were going well, they paid themselves a dividend and had more leverage, and then there was a downturn and the business went under and people lost jobs. That's all true. There's not, they're real stories, like things happen that don't go well, but it's like completely missing the forest for the trees. And there are certain sectors. So for example, there have been some problems in healthcare sectors, particularly service, like nursing homes and things like that, where there are some private equity firms in an effort to drive profitability may have cut costs too much. And that's a problem. And, regulators will look at that and say, maybe there are certain sectors where you need to have certain expense ratios or something that will do. But what happens is the public profile gets cast as the whole industry is that. And that is like a tiny, I don't know the numbers, but a tiny percent of the industry has had those problems. And you're always going to have problems, particularly if you have softness in the economy, because these businesses will have generally a little bit more leverage than their peers in the public markets.
It sounds like those stories are not always representative of the whole industry. That's what it sounds like. There's more to it. It's more nuanced to understand.
That's right.
I want to dive into one aspect that we briefly talked about, driving change. And you know that I'm a public market investor. I manage money for affluent families. And the one thing that happens, as you mentioned with Buffett, I'm a participant. I have shares in businesses for clients. But there's only that much change that I can exercise, right? I mean, there's proxy voting and of course things happen and have happened. But in private equity, you actually have both hands on the wheel, so to speak. Can you talk about that experience?
Yeah.
That's different than in public markets, unless you're an activist investor.
Yeah. Even more so than an activist. David Swenson, my mentor, referred to private equity as a superior form of capitalism. And he meant that from a number of different lenses. And one of those is that as the owner of the business, you can make every business decision. So your private equity manager is deciding, perhaps through a competitive process, but what price they're going to pay to buy the business. Right? Mm-hmm. In the public markets, you can choose that and it moves around every day. But in private equity, there's going to be one buyer of the whole business. And then you could look at every lever that you would have to try to drive change. Right. So that usually starts with management. And there are some private equity firms that will only buy businesses where they really like the existing management and they'll work with them. There are other private equity firms that will always replace the management team because that's part of their playbook. So and everything in between. So who's the leadership team? Sometimes they'll add resources, right? Particularly if you're in lower middle market or smaller businesses, those businesses may not have the resources in the past to sort of have a good CRM system so their sales team can understand profitability at a unit level or something like that. And then every aspect of the business. So some private equity firms focus on growth, and they are going to introduce the businesses they own to a whole bunch of new potential customers and try to drive revenues. Some private equity firms look at operational efficiency, and they are experts in manufacturing, let's say. So they're going to look at the business and say, based on all of our experience in the industry, we think we can improve the manufacturing. And they often will have an operating partner, so a partner of the private equity firm who's an operational expert who will go partner up with the team and help them with their operations. And then, of course, the financing side, right? That business may have a less suboptimal capital structure, or they can be nimble as rates come down. They can refinance and do it in a way that makes sense from a financier, but often operating businesses aren't as sophisticated on the financial side of their business. One strategy you see in private equity often are tuck-in acquisitions. So they can try to drive organic growth, and they can also, given their expertise in deal making, try to drive inorganic growth through acquisitions. Every lever you can imagine in capital allocation and driving a business towards profitability or higher profitability, private equity firms have at their disposal. And then at some point in time, they decide, are they going to exit the business? And how are they going to do that? So they are the owner of the business, and they do everything you possibly can with incredible knowledge and expertise, both of the industries they're investing in and the process of ownership of business to really try to drive and compound capital.
You mentioned exit, and we'll come back to it later, that it might be the case you don't have to exit the business, which I find fascinating, because in the public markets, obviously the aspiration is to buy a business you would never have to sell. So we'll come back to it in a minute. But I wanted to ask you about the change, and you hinted the last, let's say, 3 decades of private equity, just to give us this time dimension here. What has really changed? And maybe you can hint what we could expect going forward in the industry.
Well, it starts with the demand for the activity. Mm-hmm. So really, if it's, say, post-financial crisis, the really last 15 years, you've had an explosion of demand from the capital providers, which means more and more money has come in. And as more money comes in, the private equity firms have more resources at their disposal to invest in their own activities. So you've seen, in the early years, there were only a few firms that really focused on operations. A lot of it was just financial engineering. Today, every significant firm has very, very strong operations chops. And they either have it themselves, or they partner with operating partners, or they bring in consultants. Everything they do, there's expertise in how to run operations. And that's a big, big change. The other big change, which isn't as positive, is when more capital comes in, prices go up. There's more competition. So we have seen an increase in prices paid. Now, it's interesting, you've also seen an increase in prices paid in the public markets over that same time, and those two are related, because one of the entrance strategies is a private equity firm buying a business from the public markets, and an exit strategy is selling in an IPO. So there is a tie between the public markets and the private markets. So both, prices have gone up with both, which might lead you to believe that, okay, the old days of buying a business really, really cheaply and using financial engineering and getting very high returns, it's going to be harder to get the same types of returns going forward.
And it sounds like it can get competitive. If a lot of people are looking, a lot of people have the capital. And in a way, one of the things I wanted to bring up is that there's really one winner, one buyer at any given time. If you and I like, I don't know, Coca-Cola, you and I can be shareholders and still have a nice dinner and enjoy each other's company. But in private equity, usually they partner up, but you have very few participants, or sometimes just one firm, right? That's one of the elements that makes it different than public equity.
Yeah, that's absolutely right. I mean, there's only, sometimes there's, 2 or 3 for bigger businesses, but for the most part, you're right. And there are a lot of private equity firms who are all very sophisticated, looking to do deals. And so many deals are competitive auctions, and particularly as you get to bigger companies with sophistication. If you think about the process, if they're selling a division of a company, they're carving out a division, or they're selling the whole business, they have a fiduciary duty. So think about a public company that's doing a public to private. They have to run a process. They have shareholders. They have an independent board. So by definition, with some of these larger acquisitions, there will always be a competitive process. What's interesting about that is that the private equity firms have gotten very deep in industry knowledge. So some of them are industry experts. Others just have verticals. And they get to know the businesses in all those verticals for many, many years. And by the time a business is ready to transact, there are often a few, and sometimes only one or maybe 1 or 2 private equity firms that really know that business and the management team, and have a sort of an edge in even a competitive process. So that edge may not be price. They may still have to pay the most competitive price, but assuming they're paying the right price, and nobody says these, have to be fair blind auctions. It's not like the public markets. The management team who's rolling may have a say in who the buyer is. And so it's not only is it competitive in just the actual process of a sale, but there's like a pre-process. And I'll give you a corollary example with employees. So a long time ago, like when I was coming out of college, if you went to an investment banking program, you'd go for 2 years, and maybe there were a few private equity firms that would then interview people, and a few. I graduated business school in 1999. 2 or 3 of my classmates had worked in private equity firms, but a lot of them went to business school and then they did interviews with private equity firms. Now someone comes out of college and they go to an investment bank, and the private equity firms are interviewing them in their first month on Wall Street for a job 2 years later. And it's the same dynamic with companies. By the time a company goes up for sale, there are private equity firms that have been talking to them for years. And if you're just showing up at that moment, you're probably behind.
You touched on something fascinating, because in the public markets, many of us, I definitely do, have a wish list. After doing it for 20 years, I have a list of companies I'd like to own at some point, usually when the price makes sense or just the circumstances make sense. And I noticed, reading your book, listening to your podcast, that in private equity, people have that kind of a wish list, and they know those businesses for many years. So on one hand, you have all this time to get to know the businesses you'd like to own. But then I'm listening to your podcast, reading in your book, how there's this element of a certain rush that you have to get up to speed, do the due diligence, and act quickly because other people are really willing to pay and they're really ready to close the deal. So there's this dissonance in a way that you have all the time to do the research ahead of time, but then when the time comes, you have to act.
Yeah. Certainly that's one frustration I've heard over the years, particularly if someone who earlier in their career worked in private equity and moved to public equity, is they felt like they would do all this work for months on a company and then you lose the deal.
Yes.
And you feel like all that knowledge has gone away. Now, the private equity firms that have been around for 20 or 30 years build up these libraries of knowledge. And in fact, that knowledge does compound, and it may not work out for that deal, but it does end up helping for some deal down the road. But yes, that dynamic is absolutely the case, where you start doing your research, diving in on one company, and you either win the deal or you don't.
Mm-hmm. In the public market, at least I'll buy some shares. In private, you just miss out on the opportunity until next time, which can happen. And we'll talk more about it, that private equity ends up selling to private equity. So you might have a second chance or maybe a third chance to own the same business. We've been talking about, numbers and the business from that kind of scientific analytical side, but there's also the people's dimension. And there's a quote from Sachin Kajuria at the beginning of your book. He says, "This is a people business, and the magic behind its success partly lies in how these people act and organize themselves to win." Can we talk about that dimension, the people behind the businesses?
Yeah. Well, it very much goes to what you said initially about, in the quote about alignment. These are people that run the private equity firms, people that run the companies, and all of these things we've talked about. How do you build up this library of resources? These are deals. How do you win deals, right? These are people conducting transactions. And the private equity firms have been very, very good at developing their own talent and then executing that in the market. And it's probably much more than the public markets. It is a people business, because in the public markets, you can sit at your desk, read a bunch of financial statements, and then become an owner of a company. Right. You can't do that in the private markets. You have to win a deal, and there's people on the other side of that transaction, and there's a management team, and there's prior owners that you're buying from. So there's a lot of understanding, motivation, and incentives that go into making the activity work.
Well, in the public markets, I like to know who's running the business, and I'd like to understand their motivation and so on. And since the money that I invest has a long-term time horizon, I'd like them to have a long-term view, which is tricky these days. There's a lot of short-term focus, which I'm sure we'll come back to in a second. I'd love to explore 3 elements when I'm looking at your book and the stories that you share. So I see the price, the purchase, the investment horizon when it comes to private equity. So there's no daily price, as you hinted. But there are discounts that happen. So I'm curious to explore that. And then the purchase happens when someone is selling. There's a competitive auction, very few buyers. And then the best businesses you might want to hold forever, but usually it's 3 to 5 years. Can we explore all 3, the price, the purchase, and the investment horizon?
Sure. Let's do it in order. So price can change. Price is based on supply and demand. And in the public markets, it moves around every day. In the private markets, it doesn't, because it only moves around when there's a transaction. And there are, I would say, the larger the business, generally speaking, the more competitive the process, or the better and cleaner the business, the more competitive the process. And in fact, in the book, I cover 12 different deals, and 6 of them I call at the market, and 6 of them I call below the market price. So all of those at the market have that commonality, where it's a good business, people can recognize it as a good business, it's a desired asset, and there's going to be multiple bidders for that asset. There are lots of situations where that's not the case. And those include any type of distressed situation, any type of bankruptcy process, lots of carve-outs. So you could have a large, very much like the old spin-off methodology in the public markets when Joel Greenblatt wrote his first book. And it's the same idea. You have some larger corporation that has a smaller division that for some reason they want to get rid of. And oftentimes they want to get rid of it for economic reasons, but mostly non-economic reasons. Like it's not core, they're not paying attention to it or something like that. And those processes are messy. And doing a carve out is much more complex than saying, okay, Bougainville, you're going to sell this business and I'm going to buy it from you. And the day I buy it, I'm writing you a big check and you're going to go to the Bahamas and have a really, really nice vacation and might buy a place while you're there. Right? That is a transaction where you're selling the business to me. In a carve out, there's so much intertwined between the seller and the buyer that they have to create what they call transition services agreements. And they transition the business over, it could be 18 or 24 months.
Right.
So it's very, very complicated. And as a result of that, by the time you go through a process, there often aren't that many either buyers who are interested in doing all that work and seeing the value together. And so, yes, there might be an auction, but many people may walk away from that complexity. And by the time the auction's over, you may only have one bidder left, and so that price will get discounted. So those are the dynamics of price. I think on purchase, often, most of the time, unless you get to really smaller deals, you do have some type of process. And again, if it's a competitive process, it might be an auction and people are submitting bids and the highest bid wins. That's possible. In some of these more complex things, like you could think of a bankruptcy process, that's got a formal, process, a legal process of how you go through bankruptcy. And in some of these carve-outs, there is a process, but it's complicated, and it's not always the highest price bidder that wins. So that was price and purchase. What was that? The third was
the investment horizon, usually 3-5 years.
Oh, right.
But reading your book, I had a feeling that some of the businesses, some of the owners would like to hold on to.
Right. So one of the suboptimal aspects of private equity is that the structure between the general partner and the limited partner, or the private equity manager and the investor, is commonly a 10-year life fund with a few optional 1-year extensions. So think of it as a 10-year life. And in that 10-year life, they might buy 6 or 7 or 8 businesses. Now, they're not buying all those businesses in year one, right? They're spreading that out usually over, say, a 3-year period. And what you found over time is that the average ownership is only, say, 3 or 4 or 5 years, because they're stuck in this box where they go in, they make the changes that they want to make, and then they have to sell the business. And that is suboptimal, particularly with businesses that are really, really good businesses. Now, within that box, and we could talk about some innovations that are trying to change that, when you have a really good business, you've often seen it transact from one private equity firm to the next private equity firm to the next private equity firm, because they all understand that it's a really good business and they want to own it. And there are businesses that have done that. I think that we ran through it. There have been over 800 businesses in the last 20 years that have transacted 3 times with different private equity ownership groups. And a smaller number, but about 170 4 times. And 29 of them 5 times. So when you have one of these great businesses, private equity understands it and they want to own it. There are frictional costs to that, like there are in any transaction, that get borne by the LPs. And so it's not great. And you have a few, though none of them really optimal, mechanisms that the GPs have created to try to own businesses longer. So one of them is called a continuation fund. So you could own a business for a while and then go to your investors and say, we still love this business. We want to keep owning it. Now, there's lots of different ways you could do that. One is you could transact it from, say, your fund 3 to your fund 4, and you could keep owning it. The problem with that is your fund 3 investors aren't going to be the same ones as your fund 4 investors. So you have to create a fair price, and that's not easy. And another is you go to your existing investors and say, we want to continue owning this. We'll give you an option to continue to own it with us. But if you want to exit, we can also create an exit and we can bring in some other investors. That's called a continuation fund.
I find it fascinating. I feel like in the public markets, when I find something I really like, and I've looked at some portfolios the other day, and there are some holdings that have been with some clients for more than 10 years and longer. And there's no reason to sell sometimes, right? So I feel like private equity, if there was an option, a way to hold on to some of those businesses, avoid the transaction costs, and keep them in the same hands, I think the business would benefit too, right? A kind of longer stability, longevity. And then you've created the value in the first few years, moving things around, fixing things, realigning things. And then why wouldn't you enjoy a longer ride? That's why reading your book, I thought, maybe there's some room for innovation on that front.
Yeah, it happens in a lot of different ways. So the book really focuses on private equity managers that have a business in being in private equity. But you also see private equity transactions in the hands of, say, Canadian pension funds and sovereign wealth funds, where they do not have the requirements of returning capital to investors. And they can hold businesses for as long as they want. You see it with family offices as well. So the activity of private equity isn't solely done by these private equity GPs. But yeah, it is. Most of the private equity GPs do not have permanent capital vehicles and therefore cannot own businesses forever.
And you brought up Buffett, but Buffett, apart from public investments, made private investments when he bought entire businesses and basically joined the family that ran them before and let them continue to run it while owning. I want to ask about the people from a different perspective, which is something you bring up in the book. You talk about aligning incentives. And there's a story that really struck a chord with me, because you're not talking just about the executives, the top executives. You're talking about employees and how employees could become owners through the process. And it could help the business perform, because these are the people that show up every day and make it a better business. Can you talk about that idea of having employees join in the benefits of this phenomenon?
Sure. You mentioned Pete Stavros earlier. Pete is the co-head of global private equity for KKR, one of the largest, most successful private equity firms. And he came from a blue-collar family. His father had lamented not owning pieces of businesses. He implored on his son, you should be an owner. And Pete started a model at KKR where, particularly in manufacturing businesses, where they would disperse the ownership, not just for the management team, which is very common in private equity, but all the way down to workers on the shop floor and truck drivers. And it's a little more complex than just sharing the ownership, because these people aren't used to having ownership. So they need to understand, have communicated to them, like, what does it mean? Have a feeling of ownership, not just the economics of ownership. And there's a deal that we cover in the book called CHI Overhead Doors. They make garage doors, custom garage doors. And KKR was the 4th owner of the business, because it's a great business, a 4th private equity owner. But they completely transformed it primarily by this model, by distributing the ownership, by including all of the employees in new ideas and new efficiencies on the manufacturing floor. And Pete and his team did a wonderful job communicating to the employees over time. Like, they would have shareholder meetings and the employees would come and give ideas, and every year they would come up with a new idea that they would invest in that was based on what the manufacturing workers requested, and they found it was often things like safety or bringing in more air conditioning or and different things. And Pete took that model, that one deal example. As it turned out, they bought the business with $250 million in equity, and I think 6 or 7 years later, it might have been 8 years later, they distributed $350 million to the employees. And it was one of KKR's highest returning deals ever. Now, alongside of that, Pete created a nonprofit called Ownership Works. And Ownership Works is a consortium of private equity firms and industrial businesses that all are sharing the best practices of how you go about distributing ownership to the line employees in a way that's sort of productive for the business, and all the things they've learned that work, because oftentimes you try to do it and it doesn't really work. The management hasn't bought in, and it isn't as effective. To try to equal the playing field of equity ownership across businesses, below the management team.
I think there's a lesson there. Reading that part of the book, I was thinking that more businesses, not just in the private market, maybe in the public market, could realize that if you feel like you're an owner of a business, you treat your role at the firm in a different way. I think that's the overarching idea. There's one more thing in your book that really made me pause and think, and you talk about the harsh reputation of some of the firms, but then you say that there are more firms that have a kinder, gentler approach to their partnerships and investments. Can you tell me more about that? I'm very intrigued by that.
Sure. Well, again, when you have, hundreds, if not 1,000 or two private equity owners owning all these businesses, they're all different. And the reputation is the slash and burn, the old Gordon Gekko, cut costs and slash the employees and drive profits. And that exists. There are firms that do that. But there are also firms that are on the opposite end of the spectrum. And one of the ones that I cover in the book is Berkshire Partners in Boston. And Berkshire, as a firm, doesn't have corner offices. They don't have a managing partner. They're all collaborative deal teams, and the senior partners generally have worked together for 20 years. The firm has a wonderful reputation, and they do the same thing with businesses. So they never take out the management team. They only buy businesses where they want to work with the management team. 70 or 80% of their deals, the seller, whether it's a private equity firm or the management team, rolls into the ownership period with them. So they're collaborating with them. And then they work very collaboratively with their management teams to try to improve the businesses. And it's every aspect of who that when I went to do a podcast with them that turned into the chapter of the book, they asked, well, can we have two of our partners do it? Because that's how we work together. And you can hear on the audiobook or on the podcast them going back and forth with this great respect for each other and understanding of each other. So it's just very different from how people might perceive private equity as these, signs of harsh capitalism. And it's, I titled that chapter, Everyone Wins, because that's what they're trying to do.
You have one more example of what's referred to as the anti-private equity firm, and I'll ask about it in a second, but I want to build on something you touched on a minute or two ago. We talked about the price and the purchase. You talk about the 3 phases of the deal in terms of value creation, because at the end of the day, we're attempting to create value. You talk about the purchase, the period of ownership, and then the exit. And each offers its own opportunity to create value. And you refer to it, and I like the turn of phrase, the chapter of ownership. So can you talk about the 3 phases and the chapter of ownership?
Yeah. Well, we've talked a fair bit about purchase. And, that's tied to what is the business, what's happening with the owners of that business, and when do they want to sell, and all that kinds of things. And we talk some about what all the different things you can do in your period of ownership. And then there's an exit. And what you find particularly with a type of business that can be owned by a bunch of different private equity firms is that in each phase of, let's say you have a 5-year plan, to make some changes to the business. As businesses grow and mature, there are different things that you might do in that 5-year plan. And each 5-year plan you could think of as a chapter.
Right.
And sometimes the right owner for chapter 3 isn't the same thing as the right owner for chapter 4. So let me give you one example. There's an example in the book of a business called Bullhorn, which is the market leader in HR software. So it was a software business, and as you could expect, there are a few really sophisticated experts in software investing in private equity. The most famous, Vista and Thoma Bravo. And sure enough, Vista owned this business for a period of time. And no doubt they significantly improved the SaaS software that this business was doing. They sold it to 2 private equity firms, one of which was Gemstar, which is another software-focused private equity firm that probably made even more changes. And after, say 10 years, I don't know the exact time frame, of super sophisticated software investors improving the software, you probably get to the point where the software is really good. The next owner, the one we cover in the book, is a business called Stone Point, which is mostly a financial services sector vertical private equity firm. They also do a lot in HR that came out of financial services. And they looked at it and said, well, we're not software investors, but we know this industry really well. And we know a whole bunch of really important customers that they're not addressing, and we can help them grow. So the software had gotten to the point where it was exactly what it should be. Now the next owner was someone who can drive growth in the business. And that's what they did. And so it just gives you a sense that at different phases of a business, if you're partnering up with an owner, different owners may have different areas of expertise.
It's fascinating the way you put it, that basically different owners bring different lessons and experience to it and make this business better in different ways. And then at the end of the day, hopefully everybody benefits because we have better businesses all around doing better jobs and serving people with their services and goods. So I want to come back to that idea of the kinder, different. You call it, well, I think the founder of the firm calls it the anti-private equity, private equity. I'm talking about permanent equity, the firm that you feature towards the end of your book. And they're buying businesses with no debt, no intention to sell, something we talked about at the beginning. And they have investment vehicles with a life of 30 years, effectively creating permanent capital to generate returns through long-term compounding, as you share in the book. It's very much Buffett-style investing in private equity. Can you talk about that example? Is that something that more firms will follow? Is that an exception to the rule? How do you look at it?
Yeah. So permanent equity was founded by Brent Beshore, who's sort of well-known in Twitter space and social media. Brilliant business guy. And he specializes in buying very, very small family-owned businesses. And he wants to be the owner of choice. So he decided he had done this for himself for about 10 years before he took in any outside capital. And he decided if he was going to take in outside capital, he only wanted to create an incentive structure to behave exactly as he had behaved to that point in time. So raising capital for a 25-year life with extensions that can go to 30 years is not easy. And you can't raise a whole lot of capital. There aren't a lot of investors that embrace that, particularly for a new fund. But if you're able to do it, you have that opportunity to own businesses for much, much longer. And Brent has, and he's done a wonderful job doing that. So we have an example in the book of one of those businesses that he bought from a founder who remains an owner of the business. And they've owned it for a number of years now, and he potentially will own it for many, many more.
When I was reading that, I was thinking, is this the new frontier for the industry?
There are examples of everything in the industry. It's there are businesses like General Atlantic that were created out of a family office and only have one permanent pool of capital, and they can recycle their deals. That exist, and they're very, very large, multi-billion-dollar firm. It is difficult for most of the capital providers to private equity, the limited partners, to sign up for something with a 25 or 30-year life. It can happen, but it won't ever dominate the industry because things change in a partnership, right? If things go really well, it's really easy to say, yeah, of course we want to own these great businesses forever. But to think about that in scale would imply, everything, like businesses doing well, businesses doing okay, businesses outperforming, businesses underperforming, businesses that really struggle through economic cycles, partnerships that change, people that don't want to continue, don't have the same motivation 20 years later than they did when they started, friction in partnerships, people leaving, people having unfortunate circumstances that force them to leave. So because things can change as a fiduciary, it's very hard to commit to something for 25 or 30-year life.
It's fascinating. One of the things that I've learned being in the business, working with families that have an operating business, one of the lessons they shared with me is to have a way, liquidity for family partners to leave if they don't want to be a part of the family business. And I thought this is kind of a secret, but not, that sometimes some people want to leave the party and you have to have a way for them to leave that party, even if it's a family-owned business. And I thought it's quite a revelation, and maybe it's easier to have them leave than to stay and be unhappy as a part of the partnership.
That's right.
Ted, I have one last question for you.
Sure.
I'm curious about your definition of success. Like watching you, I feel like you've had many careers, many paths, many accomplishments. How do you think about success?
I think about it very personally.
Mm-hmm.
And I don't use what feels like success to me is very, very different from what feels like success to other people. And so for me, and I'm say mid-50s, it's not where I started, right? I started thinking about it in dollars for sure from my upbringing, and now it's about being in the flow. Right? Am I enjoying what I'm doing, who I'm doing it with? Does it feel like work? Because almost nothing I do now feels like work. Having ownership of my time is another wonderful lens of success that I never even understood when I was younger. And then just feeling, I was going to say fulfilled, but that's a tough one. Like feeling energized, in the present about, what am I doing today? Where am I going? Am I spending my time, as I would? And, work is part of that. If you look at all of the studies of happiness, the idea of working really hard and making whatever you want and then just retiring and doing nothing doesn't lead to a lot of excitement and happiness. So there's this, for me, success is that balance between doing things that, I enjoy and are valued by others, which matters a lot as well. And just having the opportunity to engage and be relevant and do new things all the time.
Well, I love the sound of that, and I can tell that you love what you do, and it beams through the book, through the podcast, for everything that you interact with the public through. I would bring up just one thing. I had Jim O'Shaughnessy on the show, and he told me to find something you would do, you would pay to do, not just be paid to do or do if you were not paid to do it, but you would pay to do it.
Yeah.
And I think it's a fascinating idea of finding those things in life that bring us so much joy, that if you ask me, would you pay to do it? I would say, I would pay to do it. I love spending time with the families I work with. I have a lot of fun solving problems for them, and I love finding investment ideas, and I love learning. And this conversation has taught me quite a bit about the part of the world that I'm not as familiar with, but I feel like I know a lot more after reading your book. So thank you so much for today. It was wonderful, and I really appreciate it.
Thanks for having me. Real pleasure.
You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote